How can you use tax deductions in agricultural land transactions? Imagine turning a simple farmland deal into a smart financial move that saves you money. That's where understanding tax deductions in agricultural land transactions comes into play. When buying or selling farmland, knowing how to use tax deductions can make a big difference in your overall costs and profits. First, if you are actively farming the land, you can deduct many expenses related to running the farm. These include property taxes on the land and any personal property taxes tied to the farm business. For example, if you pay real estate taxes on a 100-acre farm, those can be deducted from your income. Also, costs for soil and water conservation efforts like erosion control, irrigation systems, or planting windbreaks are deductible. These expenses help maintain the land and are recognized by the IRS as necessary for farm operations. Next, many states offer property tax exemptions or reductions for land used for farming. For instance, if you own farmland in Michigan and use at least 50% of it for agriculture, you might qualify for a property tax exemption that could cut your taxes by up to 32%. When purchasing farmland, it's smart to verify that the property qualifies for such benefits and to keep it in active agricultural use to maintain those savings. In some areas, when farmland is transferred to a new owner, the buyer might need to sign an affidavit promising to keep the land in farming use for a certain number of years, often 7. This agreement helps preserve tax benefits and prevents the land from being converted to non-agricultural uses without penalty. If the land is taken out of farming before the agreed period, the owner could face repayment of the tax benefits or additional taxes, sometimes called pop-up taxes. Negotiating these terms during the deal can protect your investment and tax advantages. Another way to save money involves soil fertility and nutrient value. Some states allow deductions based on the natural nutrients in the soil. By testing the soil and documenting its nutrient levels, you can claim deductions related to excess soil fertility, which can reduce costs associated with fertilizer and soil management. Proper documentation and expert analysis are essential here to meet IRS rules. When it comes to buying or selling land, consider how improvements like irrigation systems or drainage can be depreciated over time. Properly classifying these improvements allows you to claim deductions annually, lowering your taxable income. If you are running a farming operation, expenses related to land improvements or acquisition costs might also be deductible or amortizable, helping you reduce your tax bill. Lastly, conservation practices such as creating wildlife habitats or controlling soil erosion can qualify for specific tax credits or deductions. These incentives promote sustainable land management and can be included in your financial planning for farmland deals. When negotiating farmland deals, always review the current and potential tax benefits. Include clauses that requiring maintaining agricultural use to keep exemptions. Work with tax professionals to structure transactions that maximize deductions from conservation, soil fertility, and operational expenses. Conduct soil testing early in the process to identify deductions related to soil nutrients. And plan improvements carefully to take advantage of depreciation and expense deductions over time. Using these tax deductions and benefits wisely can help you lower the cost of farmland transactions, improve cash flow, and boost the profitability of your agricultural investments.